CEOs versus CFOs. Which corporate insiders make the best trades? Following corporate insider transactions can be a profitable investment strategy if you know what you're doing. After all, who knows the inner workings of a company better than its senior officers, directors, and significant shareholders? However, not all insider trading is worth following. For example, consider an insider cashing in stocks for a kitchen renovation. We wanted to explore who are the best insiders to follow when it comes to buy transactions that indicate sentiment. We discovered that over a 5-year period, CFOs, Chief Financial Officers, made the best annual average profit, 21.9%. They were followed by company directors who made 20.7% average profit. CEOs trailed with 19.3%. Does this mean that the safest bet for investors is to follow CFOs? Not necessarily. When we sliced and diced the data, we found out that this changes according to company size. In fact, if you had followed the buy trades of 10% owners, usually institutional investors, in medium cap companies, you would have made a whopping 56.8% annual average return. CEOs of mega cap companies made a rather handsome average return of 46.1%. CFOs of small and large cap companies also did well with annual average returns of 33.1% and 26.7%. What of penny stocks? The best performers were CEOs with a comparatively poor 9.1% average return. It clearly is worthwhile following corporate insiders. You can easily do this on tip ranks. Just head to the comments to see how and let us know if you've had success following insiders. And don't forget to subscribe for more videos like this one.